Welcome back to Smart Stock Sam, where we cut through the noise and find the setups that actually matter. If you've been watching SoFi Technologies bleed out week after week and wondering whether Friday's brutal sell-off just killed the trade entirely, or whether it quietly handed you one of the most explosive rebound opportunities of the year, then you are in the right place at the right time. Today, we're doing a full breakdown, where SoFi stands right now, why the next 30 days could be absolutely pivotal, and the exact price levels I'm watching heading into next week. Stick with me through the end, because the setup we're going to uncover is the kind that only shows up a few times a year, and most people are going to miss it completely because they're too scared to look. So let's talk about what's actually happening here, because this is not your average pullback story. SoFi is sitting right now at $15.23. If you haven't been paying attention, that number should stop you cold, because this stock was trading above $32 just months ago. We're looking at a decline of nearly 42% from its 52-week high. Year to date, this thing has been absolutely destroyed, and Friday's sell-off was just the latest gut punch in what has been a relentless downtrend. Retail investors are panicking, headlines are screaming about rising oil prices and escalating geopolitical tensions, and liquidity is draining out of high-growth tech names like SoFi almost daily. But here's the question I want you sitting with right now. If this stock is so broken, why are the smartest institutions on the planet aggressively loading up their positions while everyone else is running for the exits? Total institutional ownership is above 38%. JPMorgan Chase, one of the most sophisticated financial institutions in the world, increased their position by 37%, adding over 17 million shares. And Citadel Advisors? They grew their stake by 234%. These aren't retail traders chasing a bounce. These are the firms with the best analysts, the deepest research, and the most to lose if they're wrong. They are not buying a falling knife. They are buying a disconnected asset, a stock where the price has detached violently from the underlying business value. But even more telling than the institutional moves is what the man actually running the company just did. CEO Anthony Noto didn't wait for the price to stabilize. While the stock was sliding toward the $17 mark, he reached into his own personal account and executed a $500,000 open market purchase, not stock options, not a bonus grant, his own cash, nearly 29,000 shares. That brings his total personal holding to 11.7 million shares. When a CEO does that during a drawdown of this magnitude, he is sending a single, unmistakable message to every short seller in the market. You are wrong about this company, period. So if the CEO is buying and the biggest hedge funds on earth are buying, why did the stock just shed 40% of its value? What could possibly be powerful enough to override all of that conviction? On March 17th, Muddy Waters Research, arguably the most feared short-selling firm in the world, dropped a report that hit the market like a depth charge. They didn't just call the stock overvalued, they went for the jugular. They alleged that SoFi inflated its 2025 adjusted EBITDA by 90% and buried the headline. They claimed the company has concealed $312 million in unrecorded debt through off-balance sheet structures. That is the kind of allegation that triggers institutional-grade fear. Management fired back immediately, calling the claims factually inaccurate. But in this market, perception moves price before the facts ever get a chance to catch up. The damage was done, and that is where the opportunity is being born. Because 9 days after that report dropped, SoFi threw back a counterpunch that the market is still underestimating. The company announced over $3.6 billion in brand new funding agreements for their loan platform business, a $1 billion deal with a leading global bank, a $2 billion partnership with one of the top 5 private asset managers in the world. Now I want you to think critically for a second. If SoFi were truly a financial engineering shell game with hidden debt and inflated earnings, would a top 5 global asset manager really wire them $2 billion? Would these institutions, who employ entire armies of forensic accountants and due diligence professionals, hand over that kind of capital to a company with concealed liabilities? The answer, of course, is no. That $3.6 billion is effectively the market's own built-in fact check on the muddy waters thesis. And that creates the setup. On one side of the ring, you have the short seller narrative, alleged insolvency, alleged hidden debt, alleged accounting manipulation. On the other side, you have market reality, $3.6 billion in fresh institutional capital from the most rigorous auditors on the planet. When those two forces collide like this, it creates exactly one thing: a massive price dislocation. The fundamentals are holding, but the price is still reacting to the fear. And dislocations like this don't last forever. Now here is where the technical picture gets genuinely exciting. SoFi is currently trading 30.1% below its 100-day simple moving average. Its 200-day SMA is sitting up at $25.19, essentially a galaxy away from where the stock is right now. Think about a rubber band. The further you pull it from its resting point, the more violent the snapback when you finally let go. Right now, this rubber band has been stretched to an extreme. Statistically, when a stock gets this extended to the downside from its long-term moving averages, it is primed for an aggressive mean reversion. We call this technical capitulation, the point where the selling has been so relentless that there are almost no sellers left, and the momentum indicators are confirming exactly that. The RSI, the Relative Strength Index, is currently at 28.61. Anything below 30 is considered deeply oversold territory. But the valuation metric that really catches my attention is the PEG ratio. Yes, the price-to-earnings ratio looks elevated at 41, but the PEG ratio, which adjusts for growth, is under 1.0. For growth investors, a PEG ratio below 1 is the holy grail. It means you are paying less for the stock than the company's projected earnings growth actually justifies. You are getting a fintech disruptor with 30% revenue growth at a value stock price. That combination does not stay on sale for long. But wait, because the real accelerant in this setup isn't the fundamentals or the technicals. It's what's hiding in the short interest data. There are currently 139.7 million shares being held short. That is over 11% of the entire public float. Now here's the number that matters most. The days to cover ratio is sitting between 2.4 and 2.78. That means if every short seller tried to exit their position simultaneously, it would take nearly 3 full trading days of average volume just for them to get out. That is a structural bottleneck. That is a pressure cooker. And if the April 28th earnings call invalidates the muddy waters thesis, if management walks through that $3.6 billion in fresh capital and puts the accounting allegations to bed, those 139 million short shares will be scrambling to cover at the exact same time. That is how you get a short squeeze. All we need is a spark. So where's the floor and where's the trade? The options market is giving us a very clear answer. There is massive put open interest at the $15 strike, what traders call a put wall. Market makers have structural incentives to defend that level because of their hedging obligations. It creates both a psychological and a technical floor. On the upside, heavy call volume at $16 and $17 gives us our near-term resistance hurdles. If SoFi can break cleanly through $17, there is very little overhead resistance between there and the moving averages. Here is the setup I am personally watching. The entry zone is between $14.50 and $15.20, right against that options floor. Immediate support is $15 flat. If that level fails, there is a longer-term structural floor at $13.43. On the upside, the short-term recovery target as shorts begin to cover is $19. And for longer duration bulls, the analyst consensus price target built on 30% revenue growth assumptions is $25.91. That is roughly 70% upside from where the stock is sitting today. Between now and April 2nd, the $15 put wall is the first test. Watch whether the market defends that level as options expiry approaches. If it holds, that is your early confirmation signal. Then all eyes move to April 28th, the earnings call. That is the definitive moment, Management needs to officially integrate that $3.6 billion into forward guidance, address the accounting allegations directly, and give the bulls a clean story to run with. If they deliver, the spring uncoils. If they stumble, that $15 floor could give way. Now, before I give you my final read on this, and I always do this on Smart Stock Sam, I have to be real with you about the risks, and I need to remind you of something important. Nothing in this video is financial advice. I am not your financial advisor. Everything discussed here is for educational and informational purposes only. You should always do your own research and consult a licensed financial professional before making any investment decisions. The market can and will do things nobody expects, and that includes me. Invest only what you can afford to lose, especially in high volatility, high growth names like this one. With that said, here is my honest take. For long-term investors with high risk tolerance, SoFi right now looks like a cautious buy. The PEG ratio under 1, the massive institutional accumulation, and $3.6 billion in secured institutional funding suggests the fundamental thesis is not broken. It is just buried under a mountain of short seller noise and macro fear. For active swing traders, the $15 put wall gives you a clearly defined downside floor to manage your risk against, and the days to cover bottleneck sets up a potential squeeze towards $17 and beyond the moment a positive catalyst lands. The CEO is buying, the big banks are buying, the funding is secured, the rubber band is stretched to an extreme. The only question is whether you are willing to buy the fear while everyone else is selling it. Now I want to hear from you. Drop your price target for SoFi in the comments right now. Where do you think this stock closes on April 28th? Is the muddy waters thesis dead, or does this stock have further to fall? Let's talk about it below. If you found this breakdown valuable, do me a favor and hit the like button. It genuinely helps more people find this channel. And if you want to be in the room every time I uncover a setup like this one, subscribe to Smart Stock Sam and ring that notification bell. I drop these deep dive breakdowns every single week, and you do not want to miss what's coming next. I'll see you in the next one.